The interesting thing about that is that while tech stocks are now reacting the way they should to rising bond yields, gold stopped acting the way it shouldn't and is now acting the way it should by going up. Gold was up every day for those 4 days. In fact, it was up about...
Get ready for a candid discussion with the renowned Peter Shciff. In this video, Peter reflects on how treasuries were once considered a risk-free asset, a notion he has long contested. He cautions that treasuries still have a long way to go, emphasizing the inherent risk they carry. Peter debunks the risk-off perception associated with treasuries and suggests a path to mitigate risk by turning to gold. Join us for an exploration of the current financial landscape and the implications of rising treasury yields, with a focus on what this means for the Federal Reserve's ability to control inflation. This is a conversation you won't want to miss.
People thought that was like a risk-free asset. I was warning for years about how risky these treasury bonds were, and that thing has still got a long way to fall. I mean, it's pure risk. People were saying, oh, it's risk off. Let's buy treasuries. No, no, no. You got plenty of risk when you own treasuries. If you want to take risk off, you got to sell treasuries. Well, then what do you buy when you sell treasuries? Aha, gold. And I'm going to talk about what happened with gold when I finish dissecting the Powell comments. I got to keep scrolling up on this. And in fact, the backup in yields, the fact that the 30-year Treasury is now above 5% and rising, what does that tell you? That tells you that the markets are losing confidence in the Fed's ability to keep inflation at 2%. That's why the yields are rising. Of course, Powell doesn't get that, and I'm going to get to that question in a minute. I'm just trying to... Oh, so here's the next point I tweeted about. I couldn't believe this. So Powell started talking about the risks of inflation being too low again, right? He said that inflation can be too high or too low, and that both are risks. And he said that for a while, we had the problem of inflation being too low. And he said now, it's too high. But he's worried that at some point in the future, it's going to be too low again. And now he's going to have to deal with that problem. Like, that's a great problem to have because, A, it's not even a problem. But the consumer can use some relief. But low inflation was never a problem. That was a made-up problem so they can have an excuse to create more inflation. Now we've got a real problem of inflation being too high. Remember, it was in 2020 when Powell first introduced the concept of inflation averaging, where he said, we don't have 2% as a target. We want inflation to average 2% over time, because they wanted to justify letting inflation get to 2.25%, 2.5%. They didn't want to have to put on the brakes when we hit 2%. They wanted to make up for all the years where we were below 2%. So they redefined their target to an average inflation rate of 2%. Yeah, no one talks about that now. I mean, they haven't officially changed that. I mean, how many years are we going to have 1% inflation to average it down to 2%? Because even the Fed doesn't claim it's going to get inflation down to 2% until 2025. So that's like 4 or 5 years of inflation double, triple, quadruple 2%. I mean, 1%, we need 0. We need falling prices to average back down to 2%. Of course, no. They never want to do that. They only want to average up the low inflation. That's pretty big. I mean, if that continues, that adds up to a lot. The interesting thing about that is that while tech stocks are now reacting the way they should to rising bond yields, gold stopped acting the way it shouldn't and is now acting the way it should by going up. Gold was up every day for those 4 days. In fact, it was up about almost $60 over those 4 days. It closed the week at 1981. Now, if you remember, 2 weeks ago today, I did a podcast. It was the Friday that we got the jobs report. Gold is $160 higher than the low from that Friday. And we almost hit 2,000 an ounce earlier this morning before we got some profit taking in gold. So I guess that round number, I think the futures got above 2,000, but the spot market, I think the high I saw was about 1997 before we backed off, to 1981. But just based on where we closed, it's $160. But to the high, it was almost a $180 rally in 2 weeks. That tells me something. And, I think I was pretty accurate in my call on that Friday that we had bottomed in gold, because I really liked the one-day outside reversal day, which to me looked pretty strong. Plus, I was looking for a bottom anyway, because I knew that everything that was going on was very bullish for gold. And, the stuff that's happening in the Middle East, which unfortunately, as I said, is just getting progressively worse. And I expect that trend to continue, unfortunately. This is just adding another bullish element to the gold story, which didn't need any more help, by the way. It was already going to go way up. And oil, too, oil continued to rise. It didn't get above 90. It was at like 89.60, 89.70, and then it had a little bit of a sell-off today. It closed at 88 a barrel, but oil prices continued to rise. I expect, again, a much bigger rise. The charts look great for oil and gold, and again, bond yields too. They're all moving in the same direction. But this is significant that we saw this move up, because gold is now breaking free of this relationship it's had with bonds. Gold and bonds were falling together. Now, gold is rising as bonds are falling. That is an important missing piece to this puzzle, which is in the process of being completed. Because gold is now taking over as the safe haven. Treasuries are a risk asset. They're not a safe haven. Again, what is the risk? Inflation. The risk is also the fiscal predicament of the United States, which causes more inflation. But if that is your risk, if you're worried about spiraling budget deficits and inflation, the last thing you'd want to do is buy treasuries. And so they're not a safe haven. What is a safe haven from inflation and a sovereign debt crisis? Gold. That's what investors are doing. They're buying gold. But even gold stock investors haven't figured this out yet, because while gold was up 3% in 4 days, gold stocks didn't move very much. The GDX was up like 1.7%. The GDXJ was up 2% during those 4 days. Normally, if gold was up 3%, actually it was up 3.2%, you would expect those stocks to be up double, maybe 7%, on a move like that. 6.5% for the rest. Didn't happen. Why? Because gold is climbing a wall of worry. The investors who buy gold stocks don't believe the rally. They've seen this before. They've seen gold get up to 2,000, and it doesn't hold. Now, maybe some people think, well, it's all just about the Middle East. It's about Israel. It'll blow over. Well, first of all, the problem in Israel ain't blown over. It's going to be here for a long time. So even if that was the reason gold was rising, it's going to be a long time before that situation is resolved. But that's not the reason. It's rising because of inflation. It's rising because of a loss of confidence in the Fed, in its ability to return inflation to 2%. A loss of confidence in the sustainability of the U.S. Fiscal situation that is spiraling out of control. So I do think that we're going to break through that 2,000 resistance, but then I think gold is going to break through to new highs, because if rising interest rates aren't going to hurt gold, then that's it. There's nothing left. And it was the rising interest rates that were also pushing up the dollar. The dollar hasn't started to fall, but it ain't going up anymore. It didn't really gain any ground this week on the rise in bond yields. In fact, let me look at the dollar index on the week, and it actually declined on the week. So that's another good sign. Gold was up, shrugged off rising rates. The dollar declined, shrugged off rising rates. So this, again, brings us closer to this crashing dollar, crashing bonds, rising gold, that brings us much, much closer to this financial crisis kicking into a higher gear. As I said, we just started. It's early in the crisis, but it is going to continue to get worse.
In today's thought-provoking conversation with Peter Shciff, we've delved deep into the realm of treasury bonds and the shifting perception of risk associated with them. Peter's long-standing warnings about the risks of treasuries have proven to be on point. If you found this video enlightening, please consider supporting our channel by liking and subscribing for more essential financial discussions. Your engagement is invaluable to us. Thank you for joining us today, and we eagerly anticipate presenting you with more insightful conversations in the future. Stay informed and stay ahead in the world of finance. Until our next encounter.